friends. Welcome back to the Wall Street Skinny. I'm Jen.
I'm Kristen.
And today we are talking about entrepreneurship through acquisition. We're going to be joined by one of my Princeton classmates and friends, Jessie Sapphire. So this is Princeton episode 3 of 3 in a row because, we had to dispel the whole Brown saga that we went through after everyone was a Brown alum. So I now think we have adequate Princeton representation to be able to move on to a more diverse cast of characters after this. But we had done way back in the day, in the infancy of the Wall Street Skinny, an episode about search funds. And we were thinking of search funds in the context of the overall landscape of private equity as this kind of really unique tool that we had certainly never heard of. And I feel like we both came away from that episode, or at least I personally did. And I was like, I think I understand about 10% of what we talked about. But I'm not quite sure how it works. If that was kind of a 101 level introduction, this is a masterclass on something called entrepreneurship through acquisition. And what that is if you think about it, Chris and I have gone out and we started a company together called the Wall Street Skinny, right? And our goal is to one day grow this into a big, beautiful company, and maybe someone will buy us if we ever decide to sell, right? There is another way to become CEO of a company other than starting it yourself. And it is to go and buy an existing company and to become an entrepreneur that way. And there's two primary ways of doing that. You can do that backed by a big financial sponsor like a private equity firm, or you can take your nice little nest egg of money that you have saved up, whether it be $5 or $5 million, and you as a business person, as an investor, can go out, buy a company, and run that company yourself. And that entrepreneurship through acquisition is what we're going to talk about today with Jessie. And Jessie is incredibly, he's frank, he's forthcoming, he's so knowledgeable. He has so much insight into running a small business. And one of the things that's kind of cool is when we talk about private equity, especially in the case of the classic LBO that Kristen talks about all the time, it's the boring companies that they're buying, right? It's not the sexy tech startup stuff. It's like this company is 1 million years old and they make some kind of parts that go on some pipes or whatever it is. And Jessie's company is a printing company. But it's super cool because printing, while it kind of sounds boring, there's so much intersectionality with Wall Street. And we'll tell some of kind of the stories of how that works and what the overlap is. And printing in and of itself is actually such an interesting industry. So I'm so excited about this conversation. Jessie is amazing. Full disclosure, we had like 2 hours worth of footage. I had to cut some of it down, but we could have kept talking for another 3 hours. So I'm pumped about this. But before we get into it, Kristen, what do we need to catch up on? I feel like I haven't seen you all week because we've been head down, both trying to get stuff done for our courses.
I will say one just like housekeeping thing is, so we had been putting out 3 episodes a week, and we will go back to that, especially with regards to like our industry podcast, which we love. Like Jen says all the time, she's like, this is my favorite time of the week is when we get to record industry. Yes. But we still have 2 episodes left of season 2, and it will be coming. But it is so much time invested. It's like 5 hours to watch it. Then it's like 2 hours to record. Then it's like 5 more hours to edit. And Jen is like, again, our goal is to get the sales and trading course out by hopefully end of Q1, early Q2.
Let's not talk Qs. Let's just say, let's give it a season.
Okay.
A season that identifies as spring.
Yeah, the season of the spring. And I'm trying to finish up the M&A course because it was something that I had like scripted and had closed, but it still needed to be recorded and filmed and edited, all that stuff. So that should be out by the end of March. I feel very confident.
Let's give a Q for you.
We'll give it a Q. End of Q2. But again, like there's literally 2 of us who are doing every single thing related to this business, which is, by the way, like editing the podcast. Again, Jen was editing this
5 hours yesterday. Yeah.
Yeah. So there's just not enough hours in the day. And that doesn't count like the social media, emails, messages, all the other stuff. And then by the way, like the 6 kids, well, I guess 5.5 between the 2 of us. So we are going to be just scaling back a teeny bit for the next probably 2 or 3 months potentially. So we will be dropping industry again. Do not worry. We get so many messages from people saying like it's their favorite episode. It's ours too. We have such good, amazing guests, but like it's so much fun to talk industry. So I did want to put that out there that if you notice that there's, not an episode dropping midweek, we are taking a temporary pause, but we will be back.
And on the Skinny On as well. So it's not just industry. It's also our kind of more markets-based podcast, which I also adore. we are producing a lot of the content that would be going into the Skinny On in our newsletter. So if you aren't signed up for the free newsletter, you can get some of that content there. The more timely market stuff, analysis of ongoing deals, things that happen. I just did an article about basically a potential short gamma squeeze happening on the VIX. That's something really important to watch that could make a huge flush out of risk positions. And it's all concentrated with expiries that are coming up in the next like 2 weeks around the March Fed meeting and the debt ceiling extension limit. So like if you want that hard hitting market stuff, definitely subscribe to our newsletter. It's there along with questions that you guys have given us on Instagram that we'll be answering, almost like the Ask Me Anythings that we try to do every other week or so, but in much more detail. And we'll be answering those questions in a separate newsletter section that like hopefully feels very tailored to you and the stuff that's on your mind.
Awesome.
So
Really
there's
quickly,
all of that.
yeah.
Oh yeah.
Oh, no. This is totally unrelated, but I will
Tell
say,
me.
have you started watching White Lotus yet?
No. I heard they changed the theme song and I was like, there goes my entire reason for watching.
They sort of start to incorporate elements back in, but it's interesting because there's a whole bunch of people talking about like parallels to The Staircase, which is another like
Which I
HBO
did not
show.
watch.
You didn't?
No.
Oh, okay.
No.
I liked it. But what about Summer House? Have you started with that one yet?
No, I haven't started with Summer House. To be honest, this has taken every ounce of self-control that I have because I need to have at least 3 episodes to binge of a show. I can't do a season premiere and then wait. That is torture for me. I need to have at least 3 episodes that I can binge on like a weekend or something like that. So I'm so excited to watch Summer House. Our friend Carl Radke, if you guys haven't listened to the Carl Radke episode, I'm so excited for it. But I am seeing like posts and memes and whatever. It seems like it's going to be a good season. I'm so freaking excited.
I'm having a lot of fun watching it, but I really want to talk about it with you because we have not talked about like anything because we've been both on. You've been traveling and I've been traveling, and then we have this little contraption where normally when we're working, we like talk actually for people who are on the what's it called? On the YouTube. It's like this, it's this actually like really sad little
best investment ever. It's not sad. It's amazing.
Well, it is. It's literally an iPad that like only works when it's plugged in and it has one purpose. So you could use an iPad, but because it calls through Facebook Messenger because again, it's a meta portal. I think that they've discontinued it. But so normally we're like on the phone all the time talking, but because you're trying to record and I'm trying to record, like we don't even get to like talk that much. So we haven't got to connect on any of this stuff. So anyway, I'm excited for you to start talking about it. And I also know that
in addition to Summer House, we need to watch, if for nothing else than like Schadenfreude, the Hillary Baldwin, Alec Baldwin show. The reviews have been so damning of this thing. And I saw a clip. I sent it to you on TikTok. Yeah. And it's like Ilaria in her, and Alec is like, you're speaking English in a Spanish cadence. I literally can't understand what you're saying, as this woman from the town that we grew up with in Boston is like continuing to maintain this persona. But I saw an analysis of it that was like, this is so bleak because like not only is this in the aftermath of her having been exposed as a fraud, but it's also in the aftermath of him having killed someone. Like, I can't, I mean, I don't know if it's tone deaf is the word or like not self-aware, but I cannot imagine the pain that the family of this poor woman is experiencing watching or like knowing this show is out there and these people are just going about their lives with it. I don't know. So whatever, that got like really dark, really, really fast. Sorry.
No, I'm with you. This is so interesting too, because when I was out to dinner, when we were in Florida, the table next to me was this like group of, sort of older, like 50s, 60s, literally 6 people talking about Ilaria and Alec Baldwin. And I didn't know why. So then when you sent me that, I was like, oh, it's because the show must be out again. So that makes sense.
Oh, I can't. Did you like jump into their conversation? I totally would have.
I didn't, but I probably
like,
should have. I'm like, ooh, can we discuss? Yeah, I did not, but yeah.
Oh my gosh. Okay. Well, this has been fun as always. I've loved getting to catch up with you. I have to go for kids' birthdays. So got to get, cakes and balloons and everything for our little family dinner. And my son is obsessed with soccer, aka football. So we're going to the Charlotte FC game this weekend, which I'm so excited about. Charlotte FC is actually really, really fun to watch. Watching soccer games, by the way, for like, I know you're not like that into watching sports. I'm not. I mean, my kids were watching the University of Maryland, Michigan State, maybe? I don't know. Some college basketball game the other night because my husband went to University of Maryland for undergrad. And my husband is like screaming at the TV and my kids are like, we're watching TV on a weeknight. This is the best thing ever. And I'm like in the corner being like, oh God. Like,
well, that's because I feel like you're in such like, you're a boy household. So my husband he doesn't have, although my kids do like to watch the Eagles with him. So especially on like the Super Bowl and stuff, like, so that was actually really fun. But I think that's also why John is so excited that he's getting a boy. So like someone will watch sports because I won't. I'll be like, turn that off. And it's like, turn on The Descendants or like, turn on Cinderella. And he's just, our kids are a little younger. So that also is probably part of it, but still.
Maybe, yeah. Because like they enjoy like talking about the game theory and like the strategy. Like and they like the time with their dad. But yeah. I will say this, watching soccer or football, whatever you want to call it, is great because there's no commercials, right? It's 45 minutes with no breaks. And then
why is that? Because they don't think they can sell the advertising, or is it because
no, it's the structure of the game. It's the structure of how soccer is played. There's no timeouts. Like,
that's so interesting.
And then they add all the injury time on the end. So it's, even if like no one scores a goal, what's so painful about watching football or whatever is it's like, okay, they threw the ball. Okay, let's have a 5-minute commercial break. While they review whether or not it was a catch or whatever. And I'm like, we're going to be here for 5 hours at this rate. And with basketball, for me, it's like, why do you watch the whole thing when they're always basically tied
down to the last
until the last 90 seconds, and then they each call 5 timeouts. So let's watch the last 90 seconds because that takes half an hour, and that's my attention span for basketball. Or it's a blowout, and they're 30 points apart, and then who cares what's going to happen at the end, right? Like, what does it matter?
Yeah.
Anyways, okay. So enough. I'm so excited for this episode with Jessie. And Kristen, I hope you have a great weekend with your family.
Thank you, you too. I'll try not to ping you too much because I know you are going to be doing family
birthday stuff.
But...
No, but ping away. I mean, whatever.
All right. I will.
We'll talk anyways. Okay, bye.
Bye.
Oh, wait, no, wait. Yeah.
Jessie on. All right.
So we're joined here today by my longtime friend and Princeton classmate, Jessie Sapphire, who is the CEO of ABG Print. And Jessie is here today to talk about a whole wealth of things. But what we really wanted to dig into was entrepreneurship through acquisition. So that's something that we touched on briefly in our search fund episode. And we really wanted to get into the weeds and unpack it here because it's such a hot topic these days. Kristen was just listening to an episode of the All In podcast where they delved into some potential critiques. We want to explore it from the standpoint of someone who has gone through the process and understand what it looks like from soup to nuts. So Jessie, first of all, welcome. We're so excited to have you here.
Thanks so much for having me.
If you could just tell us a little bit about your background and then, how you ended up where you are today, and we'll get into it from there.
Sure. So I graduated Princeton in 2006 with you, Jen. And, I had a summer internship the year before at Goldman. But I wasn't the world's best student, and it wasn't necessarily a great spot. And so my first year after graduating, I was actually an English teacher down in Ecuador, which was terrific, and I really loved. Talk about this wild ride. So I'm down in Ecuador, I'm teaching English, and I'm also a professional poker player down there. I make a little bit of money.
As one does.
As one does. I make a little bit of money, and I was teaching adults, and one of my students worked for a local bank and actually was a broker, helped me set up an equity trading account in Ecuador. I start trading a few stocks down there. And then I get a phone call from a headhunter. Remember, this was the go-go days, 2000, late 2006, early 2007, right? And he was like, what are you up to? I was like, well, I'm trading equities down in Ecuador, and I hid the fact that like I'm turning $4,000 into like $12,000, right? It's like nothing. But they put me on the next flight. I'm up in New York. I interviewed, and I was the first hire at a hedge fund that was 3 people, and ended up going straight to being an investment analyst on the buy side for 2 years after that year in Ecuador. So
this is wild.
I skipped right over. Kristen, I very much could have used your training, to be honest with you. I never got it. Did that for a couple years. I will say, every time I come to New York, and this will be a recurring theme, I destroy the place. So I showed up And, it wasn't long before, and you guys have talked about this on other episodes, but, financial crisis and Great Recession and all that. And so I lost the better part of a couple $1 million on behalf of clients. This was a market neutral fund that I was a part of on a cash and beta basis, small cap equity and software and healthcare IT. And it was hard. I learned a ton. It was more like one-on-one meetings with CEOs and CFOs, are you going to make your quarter kind of thing. And I remember thinking at the time, I don't know anything, right? And I'm supposed to make these investments or recommendations, and the fund was growing. We got up to like $500 million through AUM, not through growth. And, it was crazy because I was thinking in my head, I want to do what these guys do. Like, I want to make suggestions and then execute. Like, I don't know which is, it's going to go up, it's going to go down. I don't know what I'm doing. So eventually, because when things aren't the right fit, right, I pretty much got blown out. Then I ended up working for a mortgage servicing and originations company. And the important lesson from that, quite honestly, is it was owned by a private equity company. It was actually owned by Centerbridge. And they, an individual as a sponsor, had purchased the business, served as CEO and head of strategy. And then Centerbridge had put money in with it to buy it with him. They had it for a couple of years. And then flipped it out. And they flipped it out when it was purchased by a public company. So I was part of all that. And I got to see on a much bigger scale, hold on a minute. This individual came in, bought a company, right, got outside capital, really smart guy. And I had a chance to work for a bunch of really bright people there. But then as an employee, now I had to work for the people that acquired us. And I can say this because the company has now since gone bankrupt, but they paid $250 million over the cover, right? And they
just so people know what cover is, that's the next bid back, right? So if you're the winning bid, your cover is the second closest one.
Exactly. So, I'm sitting here and let me be clear, like I was in business development, I was helping, but because I had some background in investments and finance, they brought me in for some of the work to help get the deal done, but obviously mostly run by the private equity company. But anyway, now I'm working for the new guys. They've overpaid. They have too much debt on the company. They don't know what they're doing in terms of operating. This will reoccur later for those thinking about, owning a small business. And basically ran into operational and leverage issues. And I learned a couple lessons, right? I learned I wanted to do this for myself on a much different scale. And then I learned in the corporate world, you don't necessarily control your own destiny. So I survived 5 CEOs. I was vice president of business development, working for the COO. And then they actually brought me over to run global sourcing, which is a fancy word for putting a lot of jobs overseas and offshore and cutting costs. All through this time, so my wife's in business school, I'm moving around, we're now in Philadelphia, and lo and behold, the day my daughter is born, I go, I'm at the hospital, I'm getting phone calls from all these people at the office, and I was one of the youngest vice presidents at the company, and not a lot of the other folks were having kids. And I'm thinking in my head, oh gosh, they're all so happy for me, they knew my wife was pregnant. And finally, at the end of the day, I pick up one of the calls, and they say to me, hey, Jesse, you got to be in tomorrow. Everyone got fired today. New CEO. Everyone got fired except for you because you weren't there. So the next day after my daughter's born, okay, I go in and you're basically, what are you doing? You're interviewing for the job that you have. Here was I thought, and I would suggest if anyone else is ever in this position, you're not just interviewing for the job that you have, you're also interviewing for your boss's job. And so I sit down with the CEO and basically say like, hey, here's everything I was working on. I understand you had to clean house and, you want to bring in your team, but I can add a lot of value. I apologize that I wasn't here. It was the day of my first daughter being born. And I remember him looking at me like, I can appreciate that. So I survived punchline, and sorry for making this so long-winded, but punchline,
no, you're fine.
I survived a month and a half, and I fortunately effectively got paid out. And why that was so important for me is, and I remember smiling, because whenever you get fired, I don't know if you guys have had the distinct pleasure.
I've never been fired, which is shocking. Yeah. I've only
let me tell you how awesome it is to get fired, because here's how it works, especially in the days of remote. The way you get fired is there's a meeting with your boss, but then that your boss isn't in town. And then you notice that there's a location, right? Why am I not doing this from my desk? Oh, you want to go into a room, right? But I know you're not there. So you go into the room, and then lo and behold, surprise, there's HR,
Wow.
and then your boss is on speakerphone. The HR person is extremely polite, running through very calming experience, not sharing any sort of thing that would concern you, asking you
This
if you
is
have
like
any
from Up in the Air, you know, like when they
personal.
brought all
Oh,
those people into the
100%.
firing rooms. Oh my God.
Oh, see, I'm like thinking Severance, where it's just like
I haven't
that
gotten there
calming.
Like, here's what we're going to pay you out. Here's the offer. Here's how long you have to take to accept it. You know, all that stuff, right?
Which is probably
And
like 5 minutes. Like this offer explodes once you walk out that door.
bottom line is, I'm now smiling because my daughter's now a month and a half. My wife is about to go into business school. And now I can be home and I have the equity check to go buy a business. So I learned through the hedge fund that I really want to be operating. I learned through the next step that I really want to be buying them, just smaller. And then you need a little bit of money to do it, both for the time to pay yourself to search, because searching is a full-time job, and then also the equity to go buy it. So how's that for how it all worked
amazing.
out?
Holy shit.
So-
That's awesome.
But so it sounds like there was no search fund. This was like literally like you're like,
You
I
were
have
your
a
own
check.
search fund.
You're your own search fund. You're like, I got some money. I want to go buy a business so I can like start operating it.
Yeah, so let's talk about that. So in this space, a couple broad categories, right? So you have search fund, that is, I'm raising money to pay me to go search. And once I find a business to which the people that have paid me money get to say yes or no, they will then put into the deal along with potentially other people if they can't write the whole check. And then I will be an employee of the company and I will get a percentage of the upside. Typically 25% of the upside in terms of valuation, right? So,
Oh wow, I didn't know this exact metrics. This is good. This is juicy insight.
yeah, and I can dive in a little bit tighter in a minute. But then compare and contrast that with if you are a self-funded searcher, you are paying yourself, or in this case, not paying yourself at all. You're just not getting any money while you go search for a business. Then when you go find the business, then there's another gate point, which is, are you going to buy it yourself with any savings you have, or are you going to raise money at that point, in which case you're raising it from either sort of, there's a whole cast of characters that can put in, everyone from prior searchers that have been successful and now realize what an asset class it is, right? To some funds that have sprung up that like putting into the deals at that point, because while there's lower risk, because you're not basically just backing someone in their likelihood to get a deal done, you're actually backing them as a standalone investment, if that makes sense. Like, it's different, like betting on, whether or not you're gonna be able to find a business, because not everyone finds a business. In fact, there's a lot of studies out of, like, Stanford puts on it, 75% of the people roughly find a deal after 2
Well,
years.
it's funny. I actually had seen someone use the analogy, and I never heard this before, and I actually really liked it. They were comparing search funds to SPACs in the sense that it's like you're basically giving someone money to go buy a business. You don't know what that business is yet. And then again, like, they may or may not find the business. I mean, obviously there are a huge amounts of differences, but like, I did think that for someone who was just learning, when I initially heard about search funds, because I never heard of it before, I was like, oh, that makes sense. But one quick question I did want a clarification on. You said you get 25% of the upside. Do you mean like 25% of the valuation and the equity, or like 25% of, whatever the amount is that you make, you're capped at a certain amount of sort of total?
So I want to caveat this with 2 points. The two caveats that I want to make are, every deal can be a little bit different, and that the market's constantly changing. And I did not go with this approach. That being said, the typical structure would be that whatever capital has been provided for your search counts extra, like there's a multiplier on it, and is applied to the deal. Then separately, any additional capital they put in covers the rest of the equity of the company. And then you, as the searcher, technically don't get any equity in the business. What you get is, when the business is sold, what it's sold for over what you've paid for it, plus a hurdle, you get 25% of that. And why that's so relevant is if you start looking at it, there's certain deals for which that makes a ton of sense. It makes a ton of sense for a healthcare home staffing business. It makes sense for a SaaS business where you're going to pay a higher multiple on earnings, but it's growing and it's growing fast. So that the likelihood that you're going to have an exit and an exit at a much higher amount is higher. You have natural growth in the business. Where it doesn't work is like a slow and steady single digit growing business, where in that case, the much more of the equity is going to be created just through debt repayment. And then on top of it, the reason that you want high growth, if you're doing that model, is that you're really going for the upside. And if the whole thing blows up, well, you get paid the exact same amount if the whole thing's flat, right? So I would argue you're going for upside. And then the other thing that you want to do is you want to do as big a deal as you possibly can find, because 25% of a bigger amount is better. And you're not limited by like your own equity, because it's other people's capital, OPM, as we talked about, right? Other people's money. But the only knock on size would be how much can you bite off, right? Are you someone that can step in and really run a large business? And there's some thoughts around that, which I can get into as well, which is, a lot of people think smaller is safer, but smaller isn't always safer, because smaller has less middle management, less institutional knowledge, less processes and procedures. The three of us could run Goldman tomorrow. It would probably be okay, right? Not saying we would do well, right? But it would survive. Put the three of us in charge of a deli on the corner, it would be out of business in 2 days. Right.
Yeah.
I mean, I don't know. You guys might be better at making sandwiches than me, but
No. Kristen, I literally today was like, you should just DoorDash some Robitussin. And she was like, I don't even have a DoorDash account. I don't even cook and I don't even order in. Like, she's like,
I send John out. He's the delivery person.
But this is fascinating. So talk to me about the type of operators then that would be different in each of those scenarios, the searchers versus then someone like you who chose not to go the search fund route. What do you think the distinction then is, the type of operator who is successful in each of those categories?
Yeah, I think it may be a little bit less about operator and more about both risk and reward and where you are in your life. And just to be quite candid, I mean, a lot of people don't have the equity check. They haven't saved. Like if you got through undergrad, you went through business school, you're still paying off student debt, or, you just don't have savings for any millions of reasonable reasons. If you don't have the check, this is an option that still allows you to do it. That is the more popular approach. I think in the case of many of your listeners who may be coming out of private equity or maybe coming out of banking, where hopefully they've been good little savers. And in their case, if they're able to use their own capital, they can own the business in its entirety, or they can raise only after they've searched. And the implication of that is that now they actually get real, true, honest equity in the business, right? And, in my case, for example, I own 100% of the equity. And so what I'm going after in a business that I purchased, right, was I want to make sure that the business is a cockroach. It will never die. Because as long as we're in business, and by the way, we tested that, certainly the pandemic.
Which I do want to talk about kind of like the actual trajectory of what it was like when you bought the business.
So like when I looked at, businesses, I was interested in single digit growth, because by definition, a percentage of new clients is low relative to existing clients. So there's much more stability. I was looking for a business. So the business I purchased had been around since 1992 and had been profitable every single year. Sure, it got hurt in 9/11. Sure, it got hurt in the Great Recession, but came back from both. That's even better. Like, honestly, how great do you feel about a business where you've seen it get hurt and then come back versus a business that's never been hurt? And then I focused on a business that I was familiar with. I didn't know the industry. I didn't know anything about print, but in many ways, I was typical of the type of client. I was what we call like the ICP, the ideal customer profile. So I understood the need and I understood what the business was, and it was explainable. It's a boring business, right? And that's kind of what you're looking for.
As many businesses are, right? Like, it's one of the things we talk about here. It's like, oh, private equity is doing all these sexy deals. And
they want the boring businesses.
Yeah,
that's like the
boring
golden.
You know what? Can I tell you what? I'll tell you right now. Here's the best business. The best business out there: porta potty rentals. Okay.
I'm sure.
Awesome business.
I feel like waste management, like funeral homes, nursing homes, like anything
Kristen,
that's like
wasn't
not
that the interview
sexy,
question that you asked Anish Mitra? Like, if you could invest in one thing,
I think
what would
so.
it be? And he was
That
like
sounds
a college
about right.
student, and you said funeral homes. That's what our clients really care about.
Yeah. I'm sure. But I do have a question. I mean, like, someone decides that they're listening to, they're like, I want to do this. How do you actually find a business? It's not like you can call up Jen, your real estate broker, and be like, show me all these like
Show me all the
sexy
businesses for sale.
companies.
Yeah.
Like, I worked in sponsors, and like one of the things that we would do was we would literally send the private equity firms like, hey, there's this company that's going to be going on, an auction. Like, are you interested? But if you're an individual person, I mean, you don't have like a bank who's like, hey, there's these auctions for these companies out there. How do you actually find these businesses? What are you doing? Like, how do you find
Sure.
these?
So two broad answers, and obviously it gets incredibly complicated from there. But broad answer number one, yes, there are small business brokers out there that are an entire world. So when I first started,
This is brand new information to me. I didn't know there were small business brokers.
Oh yeah, for sure. So and this is how I would end up actually in this case buying the company I purchased, ABG. So the way that small business brokers work is they're constantly sourcing, right? They're trying to find Mr. or Mrs. 75-year-old who, through death, divorce, illness, or dumb or disinterested kids wants to sell their perfectly good business, but doesn't have any other option, right? And they're getting in front of them and saying, hey, we're going to, and for the low fee of 10% of the sales price, they will help the next buyer find it. And so when I created my sort of search entity, it was called Oriana Capital. If anyone's looking for hey, literally rip the whole website and you can copy the exact same thing. I still have the brochure that I used, orianacapital.com. A bridge to your company's future, I believe, was our tagline.
Oh, there you go.
And so Oriana Capital scraped small business broker information off the internet and mailed a little brochure, same brochure still on the website, to, 250 small business brokers, one of whom a year and a half later said, oh, hey, by the way, I'm shopping this small printing business in New York. Are you interested? Right.
So that's a year and a half.
My whole search start to close. I had a couple deals that I started and then fell apart. The deal I ended up doing fell apart twice before it came together. The whole thing, start to finish, took 2 years. Yeah. Wow. I would say if you're going to do this, have a very patient spouse. That is critical. Very supportive and very.
Well,
very
Alexander
patient.
was in business school at the time, right?
She was, but if you think about it, like when you're searching for a business, and I'll come back. So the other way to do this, by the way, is direct, which is, cold email, networking, all the stuff that when you're an associated private equity that you're focused on sourcing, it's the exact same thing. So you can be industry focused, you can be focused on a geography, you can be focused in all sorts of ways. The wider you go, the more opportunities you'll find. It's all about just getting as many cycles as you possibly can. You actually, in many ways, represent the worst kind of buyer, right? Because you don't have that much money, you're not strategic, you don't have any operational experience in most cases in the industry. You're a complete risk to get lending. So you're looking for a business not only, but you're looking for a deal, right? So whatever you find and whatever's going to work for you to put a deal together, it's going to have some hair, it's going to have some spots, because if it doesn't,
somebody else would have got it. Like
someone else, those private equity people are going to go find it, right?
Yeah.
And I think that's the big thing we see with searchers now is they just aren't realistic about the fact you can tell who's ready to put a deal together and who's ready to fight through those challenges and who is Goldilocks looking for the perfect porridge.
Well, and it seems like it must be so hard because, again, you are probably bidding on the same businesses that other private equity firms are bidding on too. So
yes and no. So the distinction is scale. I mean, you tell me, but what's comp for a private equity associate right now? And then think about that, paying them to do due diligence on a deal that has $1.5 million in EBITDA, right? That doesn't work,
I see.
right?
Yeah.
So if you're playing small enough, they can't get down there unless it's a tuck-in. And if you're buying a platform and then they're going for a tuck-in, and then a lot of business owners don't want to sell to private equity, or there's other circumstances on the higher end where there's a good solid relationship, right? And there's just good old fashioned sales. They want to sell to the next version of them. So I think about it like this. Take your typical small business owner. This is his or her baby. They may have kids.
We know. Yeah.
I don't know, did either of you grow up in a family that had a small business?
No, but this is our baby.
This is our baby.
Right.
Yeah.
This is and it's a perfect example, right? Many of the business owners, they founded it. They started it. They were there through the thick and the thin, and those employees mean everything to them. And they remember now their entire family's wealth has been created as a result of this. And now they're about to let go. It's not like an old Cadillac.
Mhm.
It's everything to them. And yeah, some absolutely just want top dollar, but the vast majority, it is so, so important to them what will become,
There's
because
an
it's their life.
emotional component.
It's their life's work, and it may be porta potties, or it may be a printing company, or it may be a janitorial services business that only works for auto dealerships. But at the same time, it is everything that individual poured his heart and soul into and talked about at cocktail parties, or didn't talk about at cocktail parties, and no one asked him or her what they did for a living. They just knew that he played golf on Sundays and was a good, husband and a great dad. And there's so many businesses out there like that where it's everything to them, and so they want to sell that to someone that's going to treat it the same way.
So I'm curious, I think to help our listeners understand kind of, because you talk about scalability, right? Or lack thereof with these operations. What kind of check sizes are we talking about? You talked about like 1.5 million in EBITDA. When you're talking about kind of these nimble individual buyers out there going and buying companies versus, say, more of a consortium level approach, right? Where you've actually got the search fund, et cetera, et cetera. What kind of scale are we talking about with the equity check, so people can understand and reframe it in the context of when we talk like middle market, upper middle market, lower middle market? This is market. Like
lower, middle, micro, I think.
Basement
nano
market. Like what is this? So how do we scale this?
So if you were to look at this in terms of like, a Venn diagram, there's a lot of overlap with the circles here, but think like random person just wants to buy a business themselves is going to be anywhere from like $4 to, 2 million, right? Then maybe to phrase it differently, let's talk about it in terms of EBITDA, and honestly, at that level, they don't even call it EBITDA. They have this crazy new phrase, I don't know if you ever heard, called SDE, which is seller discretionary earnings, which is, if you think EBITDA, yeah, exactly. See how you almost vomited, right?
Yeah, that's pretty good.
If you think EBITDA is goofy, seller discretionary earnings is basically like, here's what the business brings in, including your salary.
Here's what
and
it
you
feels
work every
like
day.
Yeah, but like this is what my business identifies as bringing.
I will say though, given like Jen and I mean, given where we are, like it actually totally tracks.
So let's just say SDE from like 0 to 1 million. That's basically like just anybody buying anything, biz buy, sell. That's, you coin laundromat, the local bar, right? Then beyond that, I would say in this range of, I'm going to call it like 500,000 in EBITDA to as high as maybe 3, maybe 4, is where you're going to see the self-funded searcher. The deal I did was right in that 1.3 to 1.5.
You said 1.5.
Yeah, exactly, right there. And this is part of the distinction. And then once you get to a search fund, by definition, they want to go after bigger, right? Because bigger equity check, more. I mean, if you think the people backing them have funds, they need more money to put to work. And so they want to push you to do a bigger deal. Plus, you're aligned to do a bigger deal. So you can see people go, gosh, that is where you're really butting up against whatever you would call, like, what would you guys call lower market for private equity? You'd probably say down to 5.
I mean, that sounds small.
Yeah, I think it's like 5 to 20 million of EBITDA. I forget the.
Sure. And so this is butting up against that. Jen, you and I have, mutual friends that we know that have done, stuff like 4, 5, 6 and that in that range. And it goes up from there. But that broad strokes is where you're at. So I think on Oriana Capital's website at the time, I was looking for anything from $750,000 to 2.5 is what I was looking for. And, everyone wants all the same, great stuff: recurring revenue, contractual revenue, consistency. And then, but measured against that is the fact that small businesses are small for a reason, right? And by definition, and there's many more reasons that small businesses are small, but they're definitely small because they have some concentration somewhere. Could be on revenue, could be on supply chain, could be, hey, listen, if one of the two of you is sick, you're out 50% of your employee base today. Or, they're also small because, you guys worked at big institutions and know all about how to have access to the capital markets. Small businesses do not have good access to the capital markets. My borrow rate right now is 11.5%.
Well, yeah, let's talk about that. So then ultimately you have your equity check. What other kind of financing happens around these deals and how does that come together?
So on the debt side, believe it or not, there's actually some asset classes that can be called both at the same time. So, but for sure you have traditional bank debt, you have SBA debt, and then you have bank debt. The SBA is a great program. You do have to give a personal guarantee, and there's reasons for or against that. And anyone who owns more than 20% equity in the business has to give a personal guarantee. So that's debt on arrival for the funded search fund world.
Sure.
Right?
Makes sense. They're not giving a personal guarantee.
No, sir. Then you have more traditional bank debt that's looking like 7 years when SBA is 10. Then you'll have seller debt. Very interesting seller debt, right? Some deals can have a ton of it. And some deals that seller, is like, hold on a minute. You represent a ton of risk. You're a new operator. Why should I be having any risk about you, right? And so some deals can have a lot of it. And the interesting thing there is from a bank underwriting perspective, they sometimes see what the seller is willing to put up as seller debt almost as equity.
Interesting.
It's
so
not
how does
equity.
seller debt work? I've never actually heard of this before because that's something that's so, I feel like, specific to the smaller business world. So how does seller debt work?
Seller debt works. It's typically second lien to the first lien bank debt. Sometimes it'll be on standby until the senior debt's paid. Sometimes it goes IO and then starts amortizing. Typically it's at a fixed rate. And again, all of this could be negotiated term, principal, and rate, all negotiable. Sometimes it can be forgivable. So rather than using an earnout, you use, hey, I'm going to borrow X from you. And if the company hits this and this, I'm going to keep, but if it misses this and this, then that debt will be forgiven.
Does it work is it basically let's say you agree to sell the business for $10 million, but you can only come up with 5. So they say, pay me 5 now. And then the remaining 5, there's these terms. So you're going to have to pay interest on it. Is that kind of how it works?
Think about it like seller financing with a house, right? That's how I'm thinking.
Again,
yeah. So take a $10 million purchase price deal. Let's say you're going to get $6 million in bank debt. So let's say me, friends and family, or other people I raise from, we're going to come up with 2. And now I need 2 more. And so the seller debt would be 2. Now, obviously, when I give this example of 10's full deal, fully wrapped with working capital, inventory, everything, not just, cash going to the seller at close. It's a way to further lever the deal beyond what the bank might be willing to come with. And really, quite candidly, is a lever that's used for how sellable the business is. If you have an owner who needs liquidity and wants to get something done, he may be willing to give up more. There's the classic adage I remember even in my internship days at Goldman. I remember someone saying to me, "You want liquidity or you want price? You want top dollar? Well, then you're going to have to help the buyer out with some seller financing. Do you want liquidity? Meaning, do you want to get paid 100% upfront and wipe your hands? Right? Well, then you get a lower purchase price. And so that's how that gets reflected typically in the deal. Banks like to see seller financing, especially with searchers, because think about it. Operational transition. We want aligned incentives. We want to feel like the old owner who knows everything about the business and can totally help has a vested interest and helping. Yeah.
Okay, tell me why deals fall apart. You said the deal almost fell apart twice and that you had 3 other deals that fell apart before they got to the closing table. I'm just curious, what were some of the pitfalls that you learned to avoid?
Yeah. And by the way, I would say deals rarely fall apart because of price. You give a letter of intent, you agree on terms. A classic letter of intent has some exclusivity period in exchange for diligence, and then has how much are you going to pay me? How is it going to be structured? And when is this going down? And then what are the contingencies, right? And the classic contingencies, of course, are I get to do due diligence and I need a financing, right? So if I don't get financing or I don't get diligence, and by the way, it's also a non-binding. But anyway, after all that, deals fall apart because these are small businesses. Things change. Oh, we won a huge contract. I don't want to sell it, or it's worth a lot more, or the opposite, right? We had a bad January, or Deborah quit, and now Deborah quit, and now we haven't done invoicing. A classic one would be, oh, we discovered that you said that you had no more than 10% client concentration, but it just so happens that the top 5 clients all actually come through the exact same person, just referring you that business, and they could move it all. Oh, and you play golf with him on Sundays, right? So hey, gosh, we really need to tie him in or figure out some way to make this all work. It can come, indemnity is a big one. You can buy, typically these deals are done in an asset sale. That's where you're buying the assets. You don't have any past liability of the business. I actually did a stock deal. And so if you do a stock deal, listen, if ABG did something bad in, 1993, that's problems for me. Right now, they didn't, but okay. So how much is my set off? Or,
it's also
how
less
do we
advantageous for taxes too, usually for you, because you don't get to actually like the depreciation amortization isn't tax deductible. This is literally, Jen, what I was working on yesterday was like, we're doing our M&A course and I was like explaining asset purchase versus stock purchase. And so
it's like, oh, by the way, are you doing a stock deal or are you doing an asset deal?
Sorry, so can you just explain for the dummy in the room who's not the corporate finance person, what is a stock deal? Was this a publicly traded company?
No.
So, right. So what is a stock deal?
So if you just buy the assets of the business, right? So like, let's take your
printing
business,
presses,
right?
the whatever. Oh, okay.
Yeah, or if our business, you could buy the presses.
Use your business.
Right?
Your business is easier to understand the Wall Street skinny. Wall Street skinny is a mess.
So in our case, right, we have inventory, we have the brand, we have the website, we have all the IP in the business, we have the what they call the FF&E, right? The fixtures, furniture, and equipment, the domain, the website, all those assets. And then in addition, these are typically what are called, I'll give you another term. These deals, they're most often what are called airball loans. And what I mean by an airball loan, they're lending to cash flow. They're not lending to the asset. Like these deals, typically, I'm not like buying a building, right? If you buy a building, the bank like can foreclose on something.
Yep, there's collateral.
In my deal, if it all falls apart, right? The asset and the cash flow by definition fell apart. What is there? There's nothing there. That's why it's called an airball loan, right? So it's just on cash flow, which is another reason why they like to see seller debt and they like to see a buyer that maybe has some equity and things like that. So asset deal, you're specifically buying all the assets. Stock deal, the company has been organized and everyone has been allocated shares. All the shares may be held by one individual, and then your entity, which you've created, is assuming all the shares of that business.
Got it. Okay.
What was the rationale, I'm curious, ultimately, for doing a stock purchase versus an asset purchase?
So in my case, I did something a little bit convoluted. It's called was it a 338H10, but in English?
Yep. Okay. Yep.
Put it in English for me, please.
You get the tax deductions related to the asset purchase, but it's structured as a stock purchase. But like you still get the benefit of,
338H10. All right.
Kristen, I'll let you explain that on a future episode.
People
can look it up.
So excited about a tax code number as Kristen, who just leapt out of her chair when she heard that one.
I mean, this is literally like the shit that I teach in M&A. Like this, I mean, literally was working on these slides yesterday. So I'm like, this is exciting.
Yeah. So Oriana Capital LLC became Oriana Holdings Corp in New York. And now we're a C Corp and wrapped it all up. And probably we've now bored everyone and put them all to sleep. But these are the things.
The investment bankers are like very excited about it over here.
Okay, so you bought the company. How do you now become CEO of a printing company? You've closed. It's 2019, correct?
Yeah, June 2019. Perfect timing. What could
go wrong?
Now, remember when I said earlier in the conversation, what happens every time I come to New York City, Jen?
You blow it up. Thanks, Jesse.
So I'm in Philadelphia. Wife graduates business school. She gets an awesome job in the city. She's going to become a consultant. I'm going to take over a business that I just purchased. Oh my God, I love it when a plan comes together. We move into an apartment in New York City. We have a 3-year-old. We're young. We're living the dream. Everything is great. I step in. It's June 17th of 2019. Off to the races, taking over a business that, did not have great marketing or sales, had a really good product, great customers, but needed love everywhere, running the business.
What was your plan to grow it? What were you specifically going to invest in? Like what was your strategy to grow it right off the bat?
Take it off a yellow legal pad. So I think that's to be quite honest, and this is an area where a lot of searchers make a huge mistake. And I'm going to borrow, there's a story that's often told in the search fund space. There's this really great couple, and they'd worked in finance, and then they bought a commercial snowplow business in Maine. And she talks about, she made this amazing strategy check on how they were going to improve the whole business and fix everything about it. And then they got there, and on the first day, they realized that they were missing a third of the orders because the Wi-Fi was out in the afternoon. And
Oh
she
my
goes, and
God.
that's when I ripped up the strategy deck and I realized just make the Wi-Fi work. And so a lot of times people come in with these ideas of, because they've come out of a world where their colleagues all graduated 4-year institutions and were at the top of their class. We're talking humans with Ferrari engines, right? And now you're coming into a world, and absolutely no knock on the amazing people at both ABG and the people that work in all these businesses, but it's just not happening the same way and the same style. And so you come in, and a lot of times it's, how do we make things a little bit better, right? Remember, you're buying a business that, if you had any sense about you, was running perfectly fine, right?
Yeah.
You are the change. The only thing that changed about the business is you. If it screws up, it's on you. You paid for it. That means be really careful before you start thinking you know better and you can change a bunch of things. So, and honestly, and not to split hairs with you, Jen, I still to this day don't call myself CEO, right?
Oh, really?
Yeah. And the reason for that is also just setting, it's just about message from the top that, I come in and I was like, listen, guys, I'm a cheerleader. I'm here to make your lives better. I want to hear the problems. There's amnesty on any issues for 90 days, right? And you'd be amazed the stuff you hear that comes out of the woodwork. And little things you can fix. Some things you can't. Some things you can. Get the coffee machine working. Buy the
You
guys.
told me a story of how like the guys were leaving the floor to go get Red Bulls or something like that. So you like installed a Red Bull vending machine or something like that, right? What was that story?
I didn't even put it in a vending machine. I just buy Red Bull for the guys because we're a 24-hour business, right? We run 24 hours a day, 6 days a week, and our staff is incredibly hardworking. And I was realizing that they were leaving to run to the 7-Eleven across the street, paying like $4 or $5 for a Red Bull. It's so much easier for me to buy it by the case, keep it
I
in
can
there.
subscribe and save this or whatever.
We literally have subscribe and save, and now we
Yeah.
have multiple flavors, right? In fact, I grabbed one just to make sure I was amped enough to hang with you guys on this podcast. I'm currently having my first ever watermelon Red Bull.
Oh my God.
And it's awful, but it doesn't matter because it keeps people engaged and fired up. And yeah, don't get me wrong. Like, I put in workflow software, we introduced marketing, we introduced sales, but again, it didn't happen day one. And I now look back, I've owned the company for 5 years, and I look back at some of the things we did, and oh my goodness, how many bad mistakes I made where I just thought I knew, or thought that what was a priority versus what wasn't, right? And there's all sorts of examples like this, from personnel that you either hired or let go, to strategies that I remember talking on the first day. It's like, we do a lot of printing for investment banks. We should also print for the auction houses. It's like thinking like, oh yeah, the only reason we haven't done that is no one thought to call them. Like, that's not the reason, right? You know what I mean? So just having a sense of humility, and the great thing about running a business is it gives it to you in spades. And then, we had a little bit of an extra helping in the form of the pandemic.
Yeah, so 6 months into running this business, the world falls apart. You showed me a graph of this business that was just like steady, up, and then it was like off the charts what happened in 2020. How did you recover from that when you had a business that was so tied to the world working in its old ways and not the digital ways? It's literally a printing company. You're printing physical paper. If everyone's in Zoom meetings, right? How many millennials even have a printer in their home? I do. I actually really like my printer. But anyways, so talk us a little bit through that big step back and how you came out of it and stronger.
Sure. So I said at the beginning that every small business is small for a reason, and they all have these hidden concentrations that if you're good in diligence, you at least know what they are. Now, if you had told me when I did the deal, listen, your business requires that there continue to be in-person economic activity in New York City, I still would have done the deal.
Sure.
100%. I could not imagine a scenario where in-person economic activity in New York City would come to an end. And so when it did, and our revenue, we were down 95%. Someone flicked a switch, right? And the staff, it was really painful, right? We took the staff from 24 to 4. Oof. I go from working on the business to I'm on FaceTime helping fix a laminating machine with a voltmeter because I'm talking to, we had a lamination machine go down. I'm trying to make badges for nurses at an NYU hospital. Right.
Oh God.
And,
yeah.
Yeah, remember those badges that said like I'm smiling under here? Because the patients were so
Oh
scared because
God.
Oh
they
my
had full
God.
masks on and like
Yeah.
they like so literally we were like, what can we do to help one and two
Wow.
do anything? Because like we don't have any business. So we got connected with some nurses and made like badges that said like I'm smiling under here. And so anyway, so then the lamination machine goes down after I've agreed to do this thing just to help people.
Oh
And so I
God.
have to call a rep in the Midwest who's like, well, just run the voltmeter. And I'm like, you know that I graduated Princeton and I'm a millennial. Like we're going to have to slow this down. Right. And,
You
and,
don't have actual life skills.
and he was so patient, that guy, but you know, where do you go from there? Right. I mean, you know, thankfully prior experience, right. In terms of both copying what big businesses did. I remember seeing a headline, Boeing max draws on their working capital line. And I was like, I have a working capital line. I haven't max drawn it. Like, go. I called the bank up. Like, I had a $250,000 line. So pulled the whole thing because I don't want them being able to shut it down if they
Yeah,
see
yeah,
me
yeah.
tight on cash, right? You go into, you know, survival mode, right? Like, how can I
Mm-hmm.
conserve cash and survive? And I remember the thing that I kept, the only thing I kept thinking at the time was my biggest fear when I bought the business was I was the only thing that changed. So it's going to be really embarrassing and really awful and really humiliating if it doesn't work because it's on me. I'm the only
Mm-hmm.
thing that changed. And then the pandemic came along
Then the world changed. Yeah.
and then I thought to myself, okay, now you've got a shot. You know, it's a harder shot than you originally had, but at this point you have nothing to lose. You're supposed
Mm-hmm.
to go. If I had a portfolio of 10 businesses, this thing was going to go down. If this was a private equity company, they're not putting another dollar in. You know, credit to the United States government, right? And actually, thank you to you both. Your tax dollars very much bailed me out, right? So, and I say that to all my friends. There was PPP. We got 2 shots of that, but it was a full-time job, even going after and trying to figure out to get this money. But
Navigating that whole process. Yeah, sure.
I'll tell you a funny story. First round of PPP, here's a good one. Originally they said you have 8 weeks to spend it, meant to go on payroll, right?
Uh-huh.
Because the whole theory was this is only going to last for 8 weeks.
Right.
And instead of having everyone go to unemployment and then back onto the company, that causes a lot of friction. Let's just funnel it through the businesses. The
Let's
business will
just create
pay.
this
It's just
injection. Yeah.
unemployment in a different form. Except then by week 9, so we jumped on it. And when I fired most people, I actually fired them a week. New York saw this early, right? So
Yeah.
I let them go and I said, listen, you're not going to like what I'm saying and you're not going to like me right now. I remember the speech that I gave him. I said, but I'm just going to tell you this. You're a week ahead of everybody else on the unemployment line. And we're going to do everything we can to get you guys signed up because I can assure you in a week, it's going to be a lot harder to get on it. We got everyone signed up. And then PPV comes out and I don't have anything to print. So what's the point of bringing production people back? And I'm trying to save the business. So in my P little brain, I'm like, you know what? I know that there's a bunch of NYU and Columbia business school students that could all do consulting projects for me. Tell me how to pivot. We were doing 90% of our work for financial services. We were printing,
Yeah.
give you a sense of our business. We're doing pitch decks for Goldman Sachs at 2:00 in the morning. We print for boutique investment banks that don't have in-house printing. For the people that do have in-house printing, we print a lot of times for them when there's special circumstances for custom sizes or all that.
Oh,
you know,
interesting. Are you
type work.
doing like the bake-offs, like the huge decks that are just these like stupid place? Oh God, those are like the most miserable things to. I'm like having PTSD. Sorry.
We do a lot of IPO pitch
Yeah, those are miserable.
mandate, and they're getting they're pretty fancy and they're widescreen, and we can print custom sizes and all. Oh yeah, I don't mean to bring up trauma for you. I'm sorry.
No, it's so funny. It's like the most miserable experience because none of the sort of PowerPoint format works. So it's all so manual and it's like stupid. I had to work
continue. So you brought in these NYU and Columbia kids to tell you how to pivot, and what did they tell you?
Well, it's an example of like no knock on them, and a lot of them are great, and I'm still connected with a lot of them, right? But in my P little brain, I'm like, listen, they can help me get into a different market, or at least because some of them have worked in those industries. So I specifically hired one that like been in McKinsey but like worked in healthcare, or like been at banking but had worked in real estate. And I'm like, help me understand how I can move ABG. And now today, financial services, capital markets, and the finance industries are 40% of what we print. We've expanded. We print a ton for a bunch of different industries. And so they were helpful in that, like basically like putting pretty little pitch decks together.
Yeah.
But as we all know, and you learn this very quick running a small business, there is a huge difference in telling someone how to do something or telling them what to do or telling them how to optimize or what myths to avoid, and then actually getting it done, right? And what I would say for the guys and girls looking to get into this space, you want to be someone that knows how to get stuff done.
Mm-hmm. I'm so curious. So two questions. So it sounds like a lot of what you guys are doing is printing. Are you also then almost like having to distribute to the different banks? Because I know they're like, do people actually have to show up? Because I assume that it's like people expect that it's then going to show up like on their desk,
100%.
like when they need it. So
we deliver. Yeah.
Got it.
So mm-hmm. Go ahead. Sorry.
Oh, no. And so I actually wanted to understand too, because you were sort of in the middle of the pandemic. Everybody has stopped printing stuff. I think that at the time there was probably an expectation that this move away from paper probably would have stayed. I know that I don't necessarily print out as much anymore, although it's funny, actually, I was doing some notes for Jen and I are doing a number of classes now, and I always have to print my stuff out to like handwrite my notes so that I can see them when I actually am giving a presentation. But I'm curious, how did sort of the recovery start? And then as you're sort of seeing just like the printing levels now, how do they compare to pre-pandemic? Are we like fully back? People are printing, behavior has
Peak
kind
print.
of gone back to pre-pandemic levels. Like I'm just so curious because in my old life, I would go and do, again, all these live trainings. We would always print stuff. And then after with the pandemic, I think the expectation was, again, people would like be more PDF and it would be virtual, blah, blah, blah. But so many people still really want to have the physical paper. So what is the current trend right now too?
Sure. So the way in which you talked about the market is exactly the way a lot of people think about it and a way that a lot of searchers think about a business. Mm-hmm. And just allow me for a second to kind of critique the logic. So print overall, right, $75 billion industry, and 100% has headwinds, and 100% in some pockets is declining. I think take another industry that we all know, like consulting, maybe in a ton of trouble. But
when you dive, why is consulting in trouble?
I mean, AI is going to replace half of them.
But isn't that every business, right? Like, isn't AI going to replace half the bankers? Isn't AI going to replace half the podcasters? Like,
no, definitely not the podcasters. And AI cannot hang sheetrock, so it's not going to replace them, right?
So physical, yeah, I would agree. But like, okay, all right. So we're just saying, like, the white collar, like.
I'll come back to that point because I have some thoughts. But let's take another example. Take a software company, right? Software companies all look the same. They have salespeople, they have developers, they have the people that code, and then marketers, right? But all software companies are not the same, right? One does workflow software for funeral homes. The other one does billing software for hospitals. If the underlying business of funeral homes are not doing well, because more people are cremating.
People dying. Yeah.
Well, right. Or people are switching to cremating from coffins, right? They're not doing as well, and the industry's not doing as well, right? Whereas if you're in, doing medical billing and people are switching off paper and onto, another system, that area is going to be booming. So within print, to get back to planet Earth here, and the point is all the niches within print, some are booming, some are getting evaporated. And so where we play within ABG, to be very specific about it, is we print what people want to print. We don't print what people have to print. What people have to print is going away, right? Think like regulatory filings. Think that's going away. The reason that those IPO pitch decks get printed, Kristen, is because when they meet the management team, they feel it gets them the deal, right?
They're never 100%. Yeah.
The day they no longer believe that, they won't print it, but they do, and so they will, right? But let's take many other examples because there's all sorts of graphics and installations. We print for FAO Schwartz now, right? Where we print like literally in the toy store, right? All the graphics on the walls and all the things that get kids to buy things.
I even think about like the experience at a restaurant, right? Remember how everyone moved to QR codes like during the pandemic because you couldn't touch it. But like everyone hates them because then you're already at a meal and people are already like, get off your phone, and they're on their phone and they can't figure it out and you can't get the Wi-Fi connection to work or whatever. I remember when like the first time I went back to a restaurant and there were like menus that you could physically touch. I was like, oh my God, like I read this.
And so if you think about it, believe me, I will never, ever, ever be one of these people that like, you should print. Absolutely not. We're not here to convince anyone to print, but we're just, if you've decided that printing is good for you, we're the right people to go to. And that's who we print for because it drives them value. And so getting back to your question of in the way you described it, it was with your perspective relative to print. And you're 100% right. the areas where you're seeing it going away, it is going away, and it should go away because it's not good for you. You don't like it. You don't want it. One area we've seen, so we did a lot of printing for syndicated bank deals that would hold these large in-person meetings, right? Where, on a leveraged buyout, those aren't in person. The entire meeting is no longer in person. So that's gone away. But then we've added 5 other areas. For example, private equity companies and their investor relations groups, they are printing a ton for fundraising. All those VC and private equity guys, when they go to London, when they go to the Middle East, when they go on roadshows in New York and need to print, we print for a ton of investor days and analyst days. When you go and you sit down, you hear the management pitch and there's a presentation there. We print a ton for that. We do a lot of wide format displays when people ring the bell at the NYSE or NASDAQ. And so point being, it's totally changed. And there's some areas where it should go away. Hopefully that, because I always get a little bit I don't ever want to be one of these people that's like, no, paper's good, or like you should do this. Like,
no,
you
but I
don't.
think
why
it
would
is.
you?
Not for everything, not for like some of these stupid loan docs. Like,
I think we need to talk about the printing culture within the investment bank, because this is something so specific. So for people who have never worked in an investment bank, I think it's best encapsulated by, we talked about episode 1 of Industry, the HBO series that covers investment banking. It's one of the few episodes where they actually have the investment banking division proper, although apparently these characters just like flow throughout all the divisions of the bank equally. But there's a scene literally in the first episode where Hari, who is a character who doesn't survive the first episode, accidentally puts one slide within the deck in the wrong font. And it precipitates ultimately the circumstances that lead to his death. Watching that, I was like, this is just Hollywood. Like, the stakes are not that high. And then, of course, we've had a terrible string of actual junior people at investment banks dying because of the stress of the job. So, that is how deeply ingrained it is in the culture, that it's actually a decently accurate depiction of how high someone might feel the stakes are about one of these documents. So I'm curious, Jesse, like in your relationships with the investment banks and with the timeliness of printing and stuff like that, can you talk a little bit about the printing culture? I was telling a story before we started recording about how, like, my dad, when he worked in an investment bank, like his printer, that was like the big relationship that they had. They were spending tons of money on the bankers, like taking them out in limos and buying them lobster at the Four Seasons. Like, this is a long-standing relationship between printers and banks that has evolved over time. And I'm curious to understand what the state of that relationship is now.
Sure. So first off, that, there's been several stories, and the stories out of Jeffries is just really sad. And it does speak to the amount of time, attention, effort, and stress, and the detail-oriented nature of the work, because the outcomes are so binary and so high stakes, right? If you win the mandate for the deal, it's tens, if not hundreds of $1 million for your company, right? Versus if you're not lead left. And so the idea that you would get a page number wrong or any little thing that might contribute to an outcome, right? In the end of the day, like, what you are selling when you are an investment bank is excellence, right? You're selling perfection. And so anything you do or say or put in front of the client has to reflect that brand. And so that gets pushed down to the service providers. And that in many ways is what, we're built for. So as we say at ABG, we're so much more than just selling print. We're really selling convenience, reliability, and professionalism. And the implication of that is, this year alone, we've woken up a junior investment banker at his apartment at 5 o'clock in the morning because he hadn't approved the proof yet, right? And if we don't wake him up right now, we would have printed anyway because we're going to make sure it arrives. But like, if there are page swaps or something that needs to happen, we're doing page swaps at 5 o'clock in the morning. We have people that come in here and flip every page. And that's the difference. Yeah. We've printed the board materials for Pfizer during the pandemic, and they wouldn't even send us the electronic file. They came in with a USB stick and shut us down to print it.
That's amazing.
Just them with a skeleton crew, and then they left and ensured that the file was no longer on the computer. Right.
Wow, that's wild.
Yeah. So, but the point being, like, we recognize the severity of the work and the implication of what it means, but then also on the opportunity side, right? When you think about how work is changing for some of these analysts, the goal would be make them do the work that's thinking, but not the stress, right? Why should a 23-year-old have to worry about printing? We can handle that. We're built for that. We do it every day. Your Tuesday night emergency is our just normal Tuesday night. We're not extra staffed. We're there. That's what we're seeing, especially with the boutique investment banks, because they don't even less so want that capability, meaning internally. And so then therefore leverage our services. And then in terms of the relationship, so look, service-based professional industry that historically is high margins with a client that's not that price sensitive. I don't care what industry it is. Historically, you mentioned riding around in the back of a limousine. Legacy of the business, I'll be very upfront with you, there was a lot of people getting taken care of. And some of it was perfectly reasonable and under the realm of, hey, we'll get dinner for you because you have to be here in the conference room anyway and approve the print. And some of it was completely off the rails. When I first came to ABG, I had two top associates at a top investment bank hit me up for concert tickets, right? Just
really?
to like straight
I'm
up.
shocked that this relationship is still that extreme at this day and age.
Straight up asked for them, right? I didn't even know.
Him, like,
just
I want to go to Pearl Jam.
Right. That's basically
like,
exactly.
I'm not American Express.
Right.
But that's like the type of request that we used to get in sales at the investment banks from the hedge fund clients that you used to work for. It's all come full circle, Jesse.
Well, and now who you see it with is the data room people. So the move that I pulled. So now the data room people. Yeah. So Interlinks is taking. And by the way, so let me be very clear. The vast majority of this, and certainly with the data rooms, is above board, right? Yeah. So there's dinners, there's clubbing, there's all that kind of stuff. The data room people can still do it because they still have the kind of the large check tied to a particular event. And quite frankly, the reason that it's also happening is it's in the settlement sheet because it's all just getting wrapped up. So the fee, the bank's not paying the fee, right? It's in the deal, right? That's how those data room people are getting those fees. When I'm doing a pitch for an IPO, that's on the bank's P&L. It's that's a different world. Right. Yeah. And so now actually what we do, I'll tell you, it's our number one marketing return on investment, Chick-fil-A. We go to this, I buy $800 to $1,000 worth of Chick-fil-A, show up with a bunch of business cards, drop it down. Cause our issue is people just need to know we exist. Right. Yeah. No dog and pony show, nothing else. I show up, I give them the Chick-fil-A, which people love. Actually, I might be switching over to Raising Cane's because now they're a new client of ours and we've been printing for them. But anyway, so we buy we show up and we're not sending anybody in limos. We're not handing anyone credit cards or all the crazy story from remember, I was on the buy side, right?
Well, yeah, so that's what I'm saying.
And so I would have equity brokers trying to take me out to dinner for it was like idea dinners. And then, not a lot of ideas going on at some of those ideas. Certainly not good ideas.
So one question I have, getting back to kind of the entire business from an entrepreneurship through acquisition side, we talked to a friend of ours who was a founder, exited, and helped us think through what makes a good business versus what makes a good investment. And kind of the key to a good investment is an exit. How do you think about that, though, when you are so deeply entrenched in the business as you are, right? This is now your baby, right? This is not this some arm's length investment where you threw in, whatever. We talked about angel and seed investing on that episode. We were talking about $10,000, $50,000, $100,000 checks. This is a much different thing. But I imagine to capture some of the value, right? Exit must be part of the strategy, certainly from a search fund standpoint. Different from yours. So I'm curious. Obviously, you don't intend to go anywhere anytime soon, but just how does one frame thinking about those exits from an entrepreneurship through acquisition lens?
It's a great question, and it's a point I should have brought up earlier, so I'm glad that you mentioned it. It is a critical distinction. So when you are part of a search fund, by definition, there has to be that liquidity event. There has to be that exit. You guys might know better than I, but the time horizon is 3 to 5 years, or they start at 3 to 5 and then settle for 5 to 7.
5 to 7, yeah.
Right. And in my case, I'm, and I certainly did not come up with the phrase, but people will use permanent capital, right? Mm-hmm. So that's the other big aspect is when you do the deal yourself, you have the choice to be permanent capital or to be, and if you think about it, if you have a self-determined period where, to your point, you have to make a good deal out of a good business, which so right to point out is two different things. You have to ensure that, you can have the change in time if you need to make one. I think what I've done and the goal, right, going in was, if you're going to own it forever, it's more about the downside risk protection. And if you look at the experience of ABG, so I believe, Kristen, you asked, how we're doing. So 2024, we beat 2019, which was, after losing 95% of our revenue, right, on a 12 basis starting in March of 2020, felt like a comeback, right? And we think it's onward and upward from here. But that being said, think about the scenario I'm in. If I have a 3 to 5 year time horizon, I'm back to day zero, right?
Mm-hmm.
And so if I'm going through that at the time, and I'm looking at a time horizon where I'm a forced exit, or I really want to, be pushing to get out of the deal, I'm kind of shutting it down in April of 2020 because, why go through the damage? Whereas if you're permanent capital, 20 years from now, it'll be a story we tell, right?
Mm-hmm.
And so I think that's a big distinction in terms of both people's goals and then the type of business that they would go buy. You want to match music to words, to your point, making sure it fits. I get a lot of phone calls from folks that are looking at the commercial print industry. And I raise that point a lot, which is like, if going into it with a search fund hasn't gone particularly well, there's a couple of very public sort of private equity backed acquisitions of printing companies that have really not done well. And a combination of just bad execution, not understanding the business, but then not having the time horizon to get through it.
I love that so much, though, because I think it sort of speaks to just the perspective. It's, when we talk about buying like a house, it's like, are you buying a house to live in it and like, forever to enjoy it? Or are you buying it to flip it and try to make a profit? And it's like, you also can like create a business and create this, again, amazing brand, business, whatever, that you're going to own and hopefully create an empire versus just, well, I need to like create this thing so I can sell it so I can do the next thing. Whereas like you can actually, again, just establish yourself. That's so cool.
No, I appreciate that. And I would say, like, what's nice about it is that the individual can fit it to their life's goals. Are you a deal person that like really loves doing the deal? Then get in, get out and hire a GM, right?
Yeah.
Now, easier said than done. And there's, that's a way you can do it. Are you an operator and you love really getting in there? Go ahead. Do you want to do like buy a great platform business and then do additional tuck-ins, or, whatever strategy you want to go with it. Although I would say have some room. I certainly had no intention of being on the job training as a turnaround guy. Like I didn't want to do a turnaround. I don't like firing people. I don't like changing processes and fixing stuff that's broken. I want to grow, right? And I love talking about the positive things. But sometimes what you get dealt, you handle. And so that's the only advice I would give to folks, thinking about this is you may not necessarily get to control your own case study, if you will. I see more businesses to buy now in my network just by owning one.
I bet.
Versus when I was full-time searching. And part of the reason for that is just I speak the lexicon, I'm in the world, I'm working with suppliers every day, I understand what to look for, right? And so as a result, I see direct opportunities that I wouldn't necessarily have otherwise seen or known to look for. And also just 5 years of a little bit more understanding,
So I have a question, just wrapping this together a little bit. Who are the type of people that you think do really well at entrepreneurship through acquisition? Like, is there a personality type? I mean, I would actually almost argue that the archetype of like the business school MBA who just like fresh out of their master's program, I wouldn't think that they would be a great candidate because like they've learned the theory of stuff, but the practical application is so different. Who do you think is truly going to succeed at doing this type of search and actually trying to buy a business and run it and be successful?
Sure. So I think anyone can. So let me start there. But there's a couple of patterns that you see. So the first thing I would say, there's a lot of folks in the military who come back. And you think about like, these are amazing people that have dedicated their lives to service. And they've been associated with enormous amounts of money of expense, right?
Yeah.
Enormous amounts of responsibility with personnel, risk, and, high stakes decision making, quite literally having other people's lives, in their hands. And then they come back and they go into the corporate world, and it's just hard to care about, the marketing plan, right?
Yeah.
And getting that done, let alone when someone at the meeting says, we got to get like boots on the ground and put all hands in to, bring this one over the fence, right? You just don't look at it the same way. And I certainly didn't serve, but I talk with a lot of guys that's why they want to go do it, because, and some have shared, it's a different intensity, and it's certainly not from a danger perspective anywhere close, but they think that it's very much like the operating and the amount of attention and stress, it's definitely there. The other broad category that I wish there was more of is women. Women are excellent managers in this space. There's a lot of really successful women that the ones who have done it have done really well for the most part. And the reason for that is a combination of two things. And this is sweeping generalizations. But the first thing is it takes a combination of empathy, humility, but also like genuine skill to run these businesses. I want you to imagine like 4 back-to-back meetings, right? Meeting number 1 is your finance manager is having a really bad day because she doesn't have any kids, but she has a cat and her cat's dying. Okay. No. And then meeting number 2 is a vendor has double billed you and screwed up. Meeting number 3 is a new client pitch. And then meeting number 4 is a client that is a little bit upset because an employee commented on his or her Twitter picture. Yep. Okay. Now I want you to think about going through those meetings back to back and think about what you have to bring to each of those meetings, how you're going to get through it. And if you bring 1 ounce of baggage from one meeting to the next, you're dead in the water. And then, oh, by the way, while you get through all those meetings, then you actually have to grow the business, run marketing, run sales, and get to the rest of it. Right. And you know who's really good at compartmentalizing different aspects of their life and showing empathy and recognizing when someone needs some attention and when someone needs a kick in the butt, and then also getting stuff done? It's more often
it's
than
moms.
It's moms.
Yeah,
it's moms. Right? Like as you hear me describe it, you hear me talking about being a mom. They aren't in the space as much as I wish they were, but really think
because it's another baby, right? You have to decide that you want another baby, and it's the baby never grows up.
I wonder too if it's the risk aspect, because I do think there's a lot of women who are small business owners, but I feel like they often almost like start them. I wonder if it's the coming up with the money initially, like that initial investment of buying. I don't know. I mean, again, I'm just like thinking out loud.
You think that they're more conservative with how they invest, meaning
so let me
but
let me challenge that, right? I think you're right, but I think it's actually, let me challenge that, right? So take me. Did I get fired from my job because I was bad at my job? No. CEO changed. Right?
Yeah.
There's a lot of people that sit there and say, well, my W-2 job is very safe. Well, I'll tell you the following clients that ABG used to have. We used to have Signature Bank. We used to have SVB. We used to have Credit Suisse. I could keep going. The point being is this idea that, working in a W-2 is safe and not risky. I think people are overstating the risk of business ownership, and they're understating the risk of having a career because of all these things that can happen that have nothing to do with you. Suppose you just don't get along with your coworker, or you have a bad boss, or something, or they just decide, politics. Or there's a million reasons. And so versus when you own it or you're the CEO, bad things can happen. The pandemic can come along, or a supplier can let you down, or somebody can quit, and all the things but you know what? You also control it, and you control your destiny. Yeah. So I would challenge those people that think that it's more risky. Now, and as an asset to buy, is it more risky to buy ABG than to buy, Barclays stock?
Well, it's a concentration of risk, right? I think it's the perceived concentration of reputational employment. Like you're putting all your eggs in one basket in your type of experience, right? If you follow Jesse Sapphire's path, that's what it feels like, right? And I think that there's ways that you can fool yourself into thinking that you have diversified risk by saying, well, I work at this company. Well, guess what? You probably get paid in deferred stock in that company that incentivizes you. Like, you know what I'm saying? There's all these different ways that you have one-way risk that you don't think you do, right? That people don't perceive. And I hear what you're saying about, listen, at the end of the day, all of these risks are so highly correlated in your life. No matter what you choose the thing that's going to be most fulfilling, right? And there may be ways that you could be more successful and find it more rewarding if you're willing to reframe how you think about those risks.
I guess let me ask you a slightly different question, which is, what made you decide you wanted to go out and buy a business and operate it versus start one yourself?
Starting a business, that's incredibly risky, right?
Statistically,
Statistically,
I don't disagree. Yeah, I don't disagree with that. But
that to me, statistically, like you have to, like, by definition, you have to be irrationally exuberant, right? Just looking at the statistics. I think that the more glib answer is because everyone in life decides what they want to take on and what they think they can do, right? And then they should go after it. There's lots of people that should. Great, go start a business. Wasn't for me, right? And not something that I want. I like starting with day one having revenue and day one having profit.
Seems nice.
And day one having good people that do good work with real clients that want the thing, right? As opposed to, I'm going to start with a hand in my pocket, a pitch deck, and a prayer, and make something out of thin air, right? That seems really risky, right?
It is. It is. Yeah.
I think, and then to say nothing of the fact that you can do a great job on all of that and still not have it work out. Yeah.
I have a question for you, Jesse. Talking about this kind of relates. You and I had a conversation about Princeton reunions. So you're really involved in Princeton reunions, and you were talking about, we've got our 20th reunion coming up, not too far from now. And you were talking about getting people excited for coming back. And one of the things that we chatted about offline that I'd love to get your take on here more broadly is the biggest objection I hear from people who don't want to come back to reunions, when you really get at it, right? It's like, oh, I can't get childcare, or like, oh, it's too far away, or like whatever it is, right? But at the end of the day, they're so nervous about that moment at Princeton reunions where someone says, what do you do? And the answer isn't, I sold my company for $200 million, or I found the cure for this rare disease, or whatever it is. It isn't some big sexy thing. And I've talked about this before, how, I've gone back to reunions. I've had a different answer for what I've done many different points over my life. It was, well, I'm working in an investment bank, or like I'm a mom, or I'm a real estate agent, or sure, I now have this podcast, and all these different things going on. And I think people know me well enough by now to know that, like, I don't give two shits, right? Like, nobody cares, and I don't. But I do think that there is this perception for so many high achievers out there that there needs to be this extremely prestigious thing attached to their name. I work at a private equity firm, or whatever it is, right? We hear all the time, like, I want to go work at a private equity firm, right? And entrepreneurship through acquisition, I feel like people don't understand it enough, or don't understand what it looks like, or how it relates, or what it might be. And so I'm curious how you approach that in terms of thinking about fulfillment and how you define success as doing something that doesn't look exactly like what everybody else in the private equity and investing world looks like, and how you frame that in your own thinking.
Sure. So, and as you might imagine, when I talk to people, and thanks for shouting out Princeton 23 reunions, we're pretty excited to that, and that should be a great time. But yeah, when I'm at events like that, some people, they say, what do you do? Oh, I'm a printer, right? And then some people I say, oh, well, I acquired a business that I'm running in New York City.
I bought a company. Like, that's
right. Right.
They sound very different, right? And people are shallow.
But quite honestly, I cater my answer to what I think the other person would enjoy talking about, right? Like, first off, it's a little silly, but my new latest thing, I don't ask people necessarily what they do. I say, what's bringing them joy lately? Because it's amazing how many good answers you get. But, in terms of, you can probably tell from this podcast, I don't really suffer for lack of confidence, other than, thankfully I've been dealt a decent helping of humility in running a business, but it doesn't bother me too much. And the only thing I remember thinking when I was down teaching English in Ecuador, there was a gentleman with me that the year before had been a teacher. I think he was working for like Teach for America. And he had gone home. He had graduated Dartmouth, and he had gone home to where he grew up. And there was a bunch of his parents' friends around. And the other kids had gone and done banking or other things, like typical undergrad experience. And then when he said he was a teacher, they said, oh, good for you. Good for you. And he remembered, and he told me this story about like what it's like to hear your friends, parents
Yeah.
say that. And we
How did he
kind
take
of
that? Was that a good thing or was like a bad thing? The
well, I
good
think
for
he took
you?
it. I think he took it for what it was. They were saying, "I'm so glad you're doing this and not my kid."
Oh.
But it's like,
Oh.
it's great that
Oh.
you're doing it. But like, you
I
know,
take it as
glad
condescending,
it's
like,
not
how
mine.
nice, like, oh,
Yeah.
Right.
good, like, I don't really care, and that's not sexy and exciting.
Right. And what I would say is, I get the good for you. And some
Yeah.
people, but more often than not, I'll tell you this, I have great conversations because two to three things come out of it. The first thing that comes out of it is almost every single person has some small business either in their family or adjacent to one. And they're
Yeah.
fascinated and they're kind of secret, like really fascinated about how it all works. Like I know a guy that all he sells is the graduation tassels, and he sells graduation tassels to all the high schools in basically the United States, right?
Probably is
And
very well.
oh, I mean, yeah, he's doing just fine,
Tassel
just
billionaire,
fine.
I love it.
So if you're not too myopic on this is what I'm doing, but rather, and then people will tell you these amazing stories just about how the businesses came to be, how they evolved, what they're going through.
Yeah.
And if you're smart, you're constantly hearing for the signs of like, I have an employee who has a tulip import business that his, aunt
Sounds like
owned
they
that,
need printing.
well, I'm not focused on that. I was like, is the tulip business for sale? Right.
That's
Um,
funny.
and so, but then what's becoming more and more of a humble bag or more of a flex is not how much money a person makes, but how much control of their time they have. Right.
Mm-hmm.
Mm-hmm.
And it is incredibly
Yes
exhausting.
to
And
this.
don't get me wrong. Like you guys, I mean, all the credit to you guys in the world, right? You're monetizing 17 different ways. You're growing a community. Like you guys are like off to the races. And it's like, I can't even imagine the time investment you guys are putting in what you're doing, right? While raising kids. Yet at the same time, if you need an hour, it's yours. And that, like, I know you guys don't take that for granted. And I certainly don't. And a lot of other people, they want that and they don't have it. Right.
And I think
And
it's not just the time. I think it's the freedom to pursue the things that light you up, right? You just said what's bringing you joy, right? I find it hard to imagine, at least if someone asked me that when I was working on Wall Street, for me to be like, oh my God, it was when I just executed a 2s, 5s, 10s PCA weighted fly for a
I don't know,
like
Jen. You get
that
really
just-
excited when we watch industry and they say done. Like
I do. So, I mean, the joy that we feel about our job and that I have felt about the things that I've pursued outside of a conventional career, that to me is that's the goal. That's the exciting thing. And I want to see that in other people. I don't care. And so I think that that's something that people forget. And I just hope it can hit home for our listeners. We talked about this on another episode of our podcast that like, we never intend to retire. So many people we talk to never intend to retire. Not that they won't ever retire from like a desk job, but that they want to retire from the things that they do to kind of keep the lights on and that they want to go pursue their passions. And so I think that I hope that, anyone listening to this hears you talking about this. I mean, when we started the call and I'm like, Kristen, we're going to talk to my friend who's running a printing business. Just don't worry. It's going to be great. Like you're going to listen to this. Right. And I think you'd be hard pressed to find someone listening to this conversation who isn't like, I want to do what Jesse Sapphire's doing. It sounds so freaking cool. Right. And I think that's really powerful.
And like, I know a guy who runs, they manufacture plastic bags in New Jersey, and he was on Wall Street, he was at a hedge fund, and now he turns the machines on at 4:30 in the morning. Right. And, look, my daughter's 8 and I don't know, I'm not going to, she'll make her own decisions in life. I'm not going to force her to, run one of the subsidiaries or one of the businesses we've acquired. But I'd like to think that if she wanted to and was willing to put in the work, that nothing would make me happier.
Yeah. Oh, I love that.
I love that, Jesse. Well, thank you so much for spending time with us. This is absolutely incredible.
I really do appreciate you guys having me on. This is awesome. I have to say, like, I've been watching from afar, but you guys are really it's super fun to watch the amount of dedication you've put into like growing an audience and being patient to like get it, and then now between the training classes and the other things that you're offering, right? You can tell you're having fun doing it, but you're also getting it done. And it's super cool. I really appreciate you having me on, and I wish you guys all the success.
Oh, thank you, Jesse. For our listeners who want to follow you, I know you were really active on LinkedIn. Is that the best place for them to find you?
Yeah, LinkedIn. I mean, if you are a corporate, we print for corporations. I probably should have been more clear about that. But ABG, so we're
We'll
not
put that
interested
in the show notes as well.
Yeah,
We'll share your
no,
website.
no
info
wedding
there.
invitations, please. But or
Oh, God.
no headshots for your burgeoning model career, no matter how supportive we may be. But abgprint.com. If you're in New York or in the United States, we do jobs big and small. We just shipped 3 40-foot containers to the country of Angola yesterday. That's a story for another time. We also do pitch decks at 2:00 in the morning. So little bit of all. We're growing, and if you're a searcher and you just want to talk or you're looking for advice, get a hold of me. If you're in the print world, get a hold of me, and absolutely, hit me up on LinkedIn.
Awesome. Thank you so much, Jesse.
Awesome. Thank you.